This week on the Gray Report, we have a brand new print of the Consumer Price Index. That's the inflation report, or CPI. Going to give us a little bit of insight over the last month and just how hot has inflation been or not. Trying to give us a little bit of insight on where interest rates may go. Trying to, give us that crystal ball over the next couple of months, maybe the next year, because nobody's got it. But Matt has put together another string of awesome reports: CRD Matrix, NAR, apartment list, and then a really interesting kind of academic piece from SSRN, talking about the persistently poor performance in real estate private equity. Looking at how funds get larger, more funds, the returns go down, and how that's not necessarily the case in some other asset classes. It's really interesting, but it's not also talking about all real estate funds. So we're going to get into the details and ask some questions. Stick around for the whole episode. Make sure you've liked this video, subscribe to get all the Gray Report episodes. All right, let's hop into it. All right, everyone. Welcome back to the report. Every single week on the Gray Report, we're breaking it down. Matt, this is a great list of reports. I'm really excited to talk about some of these pieces, especially later on. This piece from the Social Science Repository Network. I'm not super familiar with them, but asking this question about, private real estate, private equity funds, investing in real estate versus kind of venture capital funds, buyout funds, and how they perform relative to real estate.
Yeah.
And how I think it's the nature of those two asset classes are different. There's different performance over time. It's really interesting. So excited about talk about that, as well as new updates in terms of kind of the multifamily market data, rent growth. NAR's got a report, but first, Bureau of Labor Statistics, CPI,
Can't miss it.
inflation. Have to talk about. Got to talk about it. Matt, let's look at the headlines.
Yeah. So just the headline numbers, CPI was up 0.4% last month. That's compared to 0.1% the month before. I don't know what is even happening. We were supposed to get lower inflation, and now inflation has bumped up. Now nominally, I think it's probably gone from 5% to 4.9%. So we can still say that on the year-over-year basis, I'm sorry, that's what I was saying. Year-over-year basis, it is maybe slightly going down. So we get that nice headline maybe. But on a monthly basis, things are still running. You know what I'm thinking though is I'm thinking about recession, all these recession fears. That doesn't seem like it's coming.
Well, it depends on, I guess, how many chess moves out we're looking at, right? And what this data really is kind of behind, it's reading a bit in between the lines, because some of it's more real time. What's the price of, gasoline and food and all that, but some of it's much more lagging, like housing, like rents.
Yeah.
And that's why, a lot of economists right now are looking at this kind of core services minus housing, taking housing out of the equation entirely, because we've talked about this, Matt, and one, we can use it to kind of forecast CPI and rent growth. We also can talk about interest rates. We know that the CPI, which housing makes up a third of CPI, we know that housing went through its weakest period of demand in starting Q3 of 22, all the way through kind of the halfway through of Q1 of 2024. We know that where CPI is reading is basically in May of 2022, when we still had really strong rent growth.
Yeah.
So it's not surprising that we still see basically 6%, rent growth year over year, and you still see monthly increases. All those increases are decreasing every month. It's slowing down, but we're still seeing increases.
Yeah.
But we also know that in the next couple months, we're going to see declines, because we know what happened last year. Like we know it's already happened. It's 12 months lagging.
Yeah. So
we have a good indication that we're going to see, if core services and the other 60% that makes up CPI, if that stays just flat and doesn't decline, which many people think that services are going to maybe decline a little bit. If it just stays flat, we're going to see just the straight CPI print decline significantly in the third quarter, and especially in the fourth quarter. And we're looking at all this in context of the market that is setting prices for interest rates, as well as the Federal Reserve's decision to either plateau interest rates at the next meeting, increase them, and then potentially, as some people are discussing, even lower them at some point. I don't even know how we can predict them being lowered the Fed
Yeah.
funds rate anytime soon. But can they continue to increase it if we have a good indication, and they know all this,
Yeah.
that CPI is going to be lower in Q3 unless, I guess, we have some crazy amount of wage growth.
These CPI numbers, I think, were pretty gratifying, probably to Powell. If they were any lower, then we have a different discussion. I almost think that a pause is just as likely now as an increase, because it's like, all right, I made the right bet.
Yeah.
I was the kind of iconoclast hawk, but now I can make this other kind of bold bet that things are going down, even though inflation looked hot. No, actually, I know. That's that's the contrarian Federal Reserve interpretation. But I also think that this does show an economy that is a little bit more healthy, I think, than people expected. An economy that maybe can body some of these blows in terms of these higher interest rates, that they can take it a little longer.
Yeah, I think that's a really good point that is missed. And honestly, man, I was thinking about that on my drive to work this morning, is that, the issues that we're dealing with are almost essentially financial, related to obviously the pandemic. We turned the whole economic engine and social engine off, and then we tried to, did a cold start on it to restart the entire economy.
Yeah.
While we were pumping fuel in, into the starters to get things going, and we should expect the volatility and the chugging of the economy coming back to life and create in ways that we could not imagine. But the underlying economy, as it was prior to the pandemic, it is strong.
Yeah.
Look at the unemployment rate right now. There's some worry signs, but mostly kind of, again, financial. Interest rates and financial tightening and monetary tightening, that's what's putting on the pressure. It's not really the underlying economy. And we're having to do all that because the economy is so hot. That's why we're seeing real time now in the multifamily industry. We're seeing strong traffic. We're seeing strong demand because people have jobs that are available. The jobs are paying more. People, I don't know. I think the people were uncertain, and they still are uncertain. But at some point, you have to start making some decisions, and there's some turnover for people saying, I need to make some life decision. I need to.
Yep.
I think that's happening in the housing market, on the for-sale housing market as well. I think people are saying, you know what, I want to buy it. Now, this isn't everybody, because a lot of people can't afford this, but the people who can figure it out are saying, yeah, I know it's not maybe a great time to get a mortgage, but I want to buy a house. And if I can, I'm going to do it.
Housing confidence is up slightly, according to Fannie Mae's most recent, yesterday or the day before. So there is as much as people are apt, I think, to be pessimistic about the direction of the country, about the economy, about the administration, about their local mayor, whoever it is, they'll be pessimistic about it. Their sentiment will be low. But you get low enough, things start to look up, and I think things are looking up when it comes to housing. The housing prices have taken a hit, and people are ready to move on. They still have to keep moving, and so I think that this CPI, in sum, the most surprising thing for the CPI was that rents grew a little bit.
Yeah.
They grew from I think it was 0.4 month over month last month to 0.6 this month. That really stuck out to me, because we're supposed to be enjoying the benefits of these lagging indicators. We're supposed to see rent of shelter coming down. I think we still have maybe a month or two of before things really kick in, because I was looking at the drop off from 2022, and it does line up to the middle of the year more than the beginning.
And Matt, which on our reports that we have today, that has a good kind of rent growth statistic.
Well, I would look at the rent track. Well,
that'd be a nice graph on it.
There's not a graph, but let's look at the RD one then.
So we're going back 12 months, basically. CPI it is looking, and so that's going to be looking at right around May of 2022. And now, again, it doesn't show exactly on this graph, but there's this point right here, which is, again, on this graph, you can't see exactly when that is, You just pull up CoStar real quick.
It's about October 22 is when you get the real dip. Now, I think that things start to level off in June.
Sorry, yeah, my time frame is off. Yeah, in April you see we have a steep rise.
Yeah, we're still in the rise.
We're still in the rise a year ago, and it's not until June that things start to really level off, and it's really not until November, December until you actually start seeing things decline.
Yeah,
and so we've got until at minimum late mid-late summer until we still some real slowing down. And not until kind of the end of the year into next year where we really see kind of the declines.
Yeah.
And that means that it shouldn't be a surprise is what I'm saying. But it also means that that's not exactly what's happening right now in the economy. And it's how much weight is the Fed going to put on that, and how much weight is the market going to put on that, pushing interest rates one way or the other.
Yeah.
And I would say with this information, I mean, I would see that the marketed bonds and interest rates that more affected by market forces like the 10-year Treasury, the longer dated bonds, we've already seen them come down quite a bit.
Yep.
I think there's a good case for them to come down more as inflation's coming down.
Yeah.
And I think the Fed funds rate's going to stay up there until Powell can see the prints to justify it. Even if they know it, they're going to hold out at least a couple months longer.
Yeah, totally.
But the big crazy thing is how well the economy is holding up and continuing to grow.
Yeah, that's it, and it was bolstered by a couple weeks ago that jobs report. You see a lot of headlines that talked about layoffs.
We need to make progress on that, which it's progress only through the lens of certain worldview.
Yeah.
But when you see job losses, we need to see like tens of thousands of job losses, not like hundreds of thousands of jobs added, which again goes for a positive note on fundamentals of multifamily and people having jobs and getting paid better. But it's not any indication that we're going to see the Fed funds rates come down any soon, because there's going to be that push from wages. And so even if we see interest rates come down a little bit as CPI decreases, there is going to be this like sticky inflation. But is it going to be, if we got 5% right now, it's not going to be 5%. We're going to rent come down. So we're being like the 3% range, 3.5%, 4% range.
Yeah.
And how, when in that situation, what does the Fed do? Because they want to get to the 2%. Do they continue to ratchet things up, or do they just say we're going to have to stay up here for a long period of time?
Yep.
Or can they start to slowly bring the Fed funds rate down? If we're at 3% inflation, can they get that Fed funds rate down to 3% over a period of time as well? Because in an ideal world, they're somewhat, if the Fed funds rate shouldn't be hundreds of basis points above the rate of inflation.
Yeah. That is a good point. And I don't think we're at the point where he's months and months away from thinking about reducing it, let alone even, I don't know, maybe he could go up next month. I think he's very much signaled that that it's going to be a pause, but that's still damage. That's still things are still tough for people. They're still going to continue to be tough for every day that interest rates are so high. And so, yes, maybe we're going to avoid recession, but things are not going to be great. It's still going to be an arbitrary lag on the economy, or drag on the economy.
I mean, just think about what are the conditions? It's a great point, Matt. What are the conditions that will cause to make the reversal to not only not have a gain of hundreds of thousands of jobs, to have a loss of tens of thousands of jobs? Yeah, that means we're going to find the business conditions have to get much, much worse, and demand has to go much further down.
Yeah,
and we're not even close to that. I mean, and again, the areas that are most interest rate sensitive. You're talking about housing again. We're not seeing the major price drops. We're still seeing the housing market kind of move on and chug along.
Yeah.
So then that's somewhat that is lagging also, but been a decent amount of time, and I think we're waiting, especially in commercial real estate, for some things maybe. So obviously the whole story isn't written, but like not really making much progress in those areas that you would think would be the first to make progress.
Yeah, it is crazy how quickly things are moving and changing, and how and the only thing that could really help us is the slowest moving tool that we have. Like, oh man, we got to wait a year to really know if it worked.
Yeah. Yeah. What people are hoping for, we're in uncharted territory. Everything that's going on, like we shouldn't have an unemployment rate so low, right?
Yeah.
And so it's like, will there be this idea of it's beyond Goldilocks? It's, this immaculate, disinflation story that people are talking about of like, we still have, very low unemployment, but cost of other services starts coming down. But how do you do that when the labor market is so tight, which puts pressure on wages, and as pressure gets put on wages, you have to increase the price of goods and services. So it's like it doesn't compute, but a lot of what's been happening hasn't computed.
I again, like, this is the pandemic. It is like this exogenous, black swan event. That it seems that makes things hard to predict. We're trying to put models in that maybe didn't have a pandemic as a factor in, like, the supply chain and everything.
No one's ever turned everything off before.
Yeah.
I mean, no one has turned just like the global machine just like off, like because governments, we're so scared. People are telling us to do something we don't know what to do. We're just going to turn it off. We're just going to flip the switch. Like, what happens? We don't know. Just do it. And then we're like, have we ever turned the thing back on before? No, we haven't. And the thought process at that point was everything was bad, so we'll just dump. We need a lot of fuel to get it started, so let's dump all the fuel we can. And we started, and it's like, oh, we've like created a little bit of an explosion. It's too hot. Too hot. We're running. It's like you got the choke still in. It's like we got to pull the throttle back a little bit. Now they're trying to choke it enough, but it doesn't kill the engine.
I think that there's still some drama. We may look back at the beginning of this year, and as shaky and uncertain, it was dotted with some notable bank crises. But we may look back and say, "Oh man, we thought things were bad and scary, but now we're facing facts now." I am very curious to know, like, is it going to hurt every sector? Is it going to be concentrated in one sector?
I think there's going to be some. I mean, that's the one good thing about multifamily. I mean, if you look at multifamily compared to other sectors, I mean, we can paint the downside, but relative to like almost every other area in the economy, no matter, I mean, people still need a place to live. Housing still is in demand. We still don't have enough apartment units, just housing in general for the amount of people. Maybe that might not be the case in 15 years. But certainly right now we have a big deficiency and a demand imbalance. That's not going away. With wages growing, we're seeing rent growth. Again, it's a valuation issue relative to financing issue. And we are going to there's going to be some readjustments, and the market hasn't really decided, but relative to the new environment of what expenses are, because right now this year's expenses certainly aren't 2020 to 2019. So not even the first half of 2022. It's like, what, recent expenses, what are they? They're way up. And so there's a new paradigm there. And then where rents are today, what loss to lease can be absorbed over the next couple of years, and what's a reasonable expectation for rent growth. I think that it's above the norm of 3% because we're going to see a little bit of a higher degree of inflation, but we really don't know. And what is that going to look like? And then how do investors value and put a premium on the risk taken and want to allocate to multifamily? And that's the big question of valuation. Will people accept cash flows that are in the mid to low single digits, and IRRs that are sub 15? I don't think so right now, like today. But there is so much institutional demand that that's just what the return profile may look like if there is so much demand. And I'm hoping for opportunities that, get a ton of cash flow and high total returns. That opportunity may be very short-lived, and the market may decide that, hey, we really like multifamily, and even though interest rates are relatively high, we'll pay a relatively low cap rate for it because it's where we want to be, and we'll accept low cash flow and low returns, and that'll be a challenge for ongoing deals.
Yep.
Just because it's become more and more favored investment class, and it's relative to what we're going to be looking at a little bit, talking about real estate funds versus others.
Yep.
But like, the more capital going towards a thing, the return goes down.
Yeah.
There's more demand for it. The return's going to go down. There's not enough room for everybody. And you're going to have to be more creative to create value and find value, and to maintain those higher returns. And so that'll be great for current deals and great to get into deals now, but it'll just be a different return profile. Maybe the risk profile will be even lower because there's so much demand, more institutionalized. But we're hearing from more people. They're like, we're ready to jump in and buy more multifamily. But just like today, it's hard to make sense of it because the price that would get me excited is way, way below what the seller wants.
Yep.
Way below.
Yeah. Little change.
And I don't like, not lowballing. It's just like, it's math. It's like pretty simple math. So enough of me going off, Matt. Where do you want to jump to?
Yeah, let's talk about this NAR, this National Association for Realtors report on April 2023 CRE markets. To hold over for last week, but it hasn't gotten old. It gives us a good overview of the landscape of CRE in our current moment. The multifamily section uses CoStar data, which has it has rent growth at a little lower than other market rent growth trackers. 2.5% year-over-year rent growth, a little lower than the 3 to 3.5% average that we're seeing from other sources. So I just wanted to keep that in mind. That being said, the NAR report further emphasizes a common assessment of the multifamily market in this current period. Overall, the multifamily sector is returning to its pre-pandemic state. We're not seeing the low points we saw last year. We're not seeing the dizzying high growth that we saw in 2021 and early 2022. The reason why I downloaded and am covering this is because I want to compare multifamily's normalized performance with other sectors. So for office, outlook is not good. If you look at the graph they have for quarterly absorption, you really see how there are massive negative numbers through 2021 that gave way to a slightly positive absorption in 2022, the first 3 quarters. But then the office market swung back into the negative in Q4 2022 and had even worse numbers for Q1 of this year. This is the office market, and I was talking about this yesterday. The office market, the story for that is, people thought it was going to do badly, and then it did badly. The industrial market is people thought it would do great. It did slightly less than great, so people are slightly disappointed, but still far and away doing better than I think any other asset class at this moment. If multifamily's back to pre-pandemic normalization is a relief kind of for people that saw these lower rents, this persistence of above normal performance should be cause for celebration for industrial investors. There are a lot of different reasons and different factors that go into multifamily demand. And so it's kind of hard to kind of explain every single one of them, because a lot of times I'm thinking, well, we're moving maybe back slightly to service, to a service level economy rather than a goods level economy, but industrial still is in demand. And then, also there is like this reshoring that could be supporting industrial demand. But then like the supply chain problems, I don't know if they've gone away all the way, or, how the industrial development and demand for industrial spaces is kind of clued into that. And then also the demand from retail, bolstering the industrial market. All of these questions, when it all shakes out, it really looks like industrial is doing quite well in face of uncertainty everywhere else. It's got 10.3 year-over-year rent growth, so it's still pretty hot.
Yeah.
And then the last one I want to cover, and I didn't really mention hotels, but I want to cover retail as a sector that has been remarkably resilient this past year and really beating back a lot of expectations that the sector was doing poorly. Expectations that I think began during the pandemic, never really let up, and never really came true in the same way as the office market. Retail, so if the story of industrial was, well, it did better. Multifamily did okay. And retail's one that you thought that everyone counted it out at the beginning of the pandemic.
Retail is so, it's like not all retail is the same.
Yeah.
Some of it's done really well, some of it not at all.
And that's the thing too, is like, and I was talking to someone a couple weeks ago, and they were talking, oh well, commercial real estate's doing bad. I mean, you see those the retail, like, and they are pasting their image of a forgotten sleepy strip mall that has a bunch of vacancies across the whole retail landscape, and that's not fair.
No, yeah, not at all.
Yeah, the real estate market is performing much better than the dying strip mall that you pass on your way to work every day. But that's kind of the sum total of where all these other sectors are, and frankly, they're not doing too bad. It's really office markets is at the center of a crisis. There's no getting around it.
No, fundamentally, everything else seems to be on solid footing. Besides, kind of financing and interest rate wise, but except for office is in a tough spot fundamentally, and they've got the financing issues. Yeah. One other just piece, Matt, that I thought was interesting, and I think this really sums up some of the weakness that we saw end of last year in multifamily, early this year, is the net absorption was 82% lower than the previous year.
Wow.
And vacancy rate has increased 6.7 from 5%. To 6.7 from 5%. So basically, absorption just cut by 80%. Now, I know last year was a high, so it's not like 80% from normal.
Yeah.
But still, that's the difference between last year and this, what we've seen.
And I've seen reports too, and because RealPage had a report a couple weeks ago that talked a little bit about, we saw this dip down of demand. I think it may be coming back up to kind of compensate for that.
I think so too. Yeah, no, we're seeing that for sure. But it just again, in reference CPI discussion, that. No, that hasn't shown up yet. Yeah, and we're digging out from that hole right now.
Yeah, and that's, I think, the story. And if you want to get into the Yardi Matrix National Multifamily Report, that's the story, I think, of Yardi of rent growth. I said last week, I said positive but not powerful. I think it's a little bit more powerful than I expected it to be. Now that we've gotten
determined.
Yeah, it's more determined. That's right. Because a couple more monthly rent growth reports have come across, and I have identified a little bit of a pattern here.
Oh yeah.
I think it goes a long way to illustrate something I like to call a trend. So I'm going to be referencing this Yardi Matrix report as well as a little bit of some other information from other rent reports to make my case. But first, the headline numbers before getting into the meat of my argument. Year-over-year rent growth is at 3.20% according to Yardi Matrix. That is down from an even 4% last month. Month-over-month rent growth is at 0.3%, which is up from 0.2% last month. Here's a trend. Annual rent growth down, monthly rent growth up. That's my trend. Annual rent growth is down, and this is why I was talking about that period of time where you can really see a lot of high year-over-year growth. When we were talking about the CPI, if you cut it in the right way, you could see lower year-over-year, even as your monthly is going.
Exactly. We're talking about it's like a base effects, and again, we were just looking at the graph. I mean, it makes sense. Yeah, a year ago, year over year, what was happening a year ago? Well, it was increasing quite a bit at a very high rate. And so it's not necessarily that it's not as much year over year isn't as good a metric. It's important to know, but it's less indication of what happened this month. And it's more of an indication of what happened last year.
And when I was looking back, because I maybe jumped the gun by a couple months.
And if there's still growth, it's all compounding growth. It's growth on top of growth. Yeah. We saw some declines in some markets, but
yeah. And when I was looking at the month over month rent growth for last year, April was roughly a high water mark when you're talking about like these shorter term month over month growth. It grew by a full % in 1 month. So the story back to our current position 12 months later is we're going to see lower because we're comparing it to that really active month last year. But what about monthly rent growth? This, in the recent months, in the recent few months, I think monthly rent growth has been up. I think we should get excited. I don't think this is a trick. I'm going to draw on one
trick.
Well, because it's like, well, you got 4 months. My argument is from January to April and likely till May. We have had consistently higher month over month rent growth. Places like Yardi Matrix, CoStar, RealPage, Zumper, Zillow, Realtor.com, Redfin, Apartment List, and CPI. Let's throw out CPI, but all of those have month-over-month rent growth rising consistently since January 2023. Every single market rent tracker, except for one, which was the apartments.com rent data, which recorded a strong 0.4 rent growth in January that is the same as this month. But for all of the other data sets, and really in the aggregate, if you look at the average, there is a solid rent growth in the past 4 months. And the trough of the rent growth trends really happened around December, January. So we're still digging out of it. We're still going to be
Which makes sense.
But it is a robust trend.
Makes sense from a seasonal standpoint, just the way things have, occurred last year with the economy and interest rates in that cycle as well. Matt, I want to take a quick turn to look at some of these renewal rates, because that's one of the other pieces of, rent growth and total income. It's not just what your market rent is, it's what the rate of where you are renewing your existing residents. In the past, renewals were sometimes just nominal. Like, we're going to raise rents $5, $15, $25, over your previous month because we want to keep you up. And renewal rates typically were like 50%. It was like half of your property is going to turn over. That was on average. But starting the pandemic, renewal rates started skyrocketing and people weren't moving. And then all of a sudden, vacancies were down so much and rent started rising so much that the difference between in-place rents and renewals and market rent was so wide.
Yeah.
And since we were 100%, that people were 100% occupied, we needed to create some vacancy and to say, look, like, you can't be so much under all of the new residents that live here.
Yeah.
And so many operators, including ourselves, started pushing renewal rates more than your typical $5 or $25 as well. And so we saw that really pick up. And no one really wanted to do anything in 2020 because people didn't want to do anything with anybody. But in 2021, everyone realized that there had been a lot of rent growth that happened. And so on the renewals, you see that the percentage of rent increase moved from basically again, it was like 0, to all of a sudden like 8% and even peaking at close to, 12%. But the renewal rates we saw, go all the way up to kind of mid 60s from they were kind of in like the high all throughout the pandemic. This graph only goes back to January of 2020. But it goes from like mid 60s to very like high 60s. But we've seen that decrease starting last year. And we saw this cross, and that's where the rent growth on renewals has started to decrease as well.
Yeah.
So it'll be interesting to continue to track this. I mean, again, this is another story of returning to normalcy. I think we're going to be getting back closer to that kind of 50% range, but we're not there yet. And it'll be interesting to see. I think we're going to see continued larger increase of renewals because there's still a decent amount of loss to lease at a lot of these properties between the new market rent growth and pre-existing leases.
Yeah.
There's less of that, but there's still quite a bit. And we've seen, again, compounding rent growth past couple of years. And if you haven't had your rent increase, and there's still people that just haven't had their rent increase over the last couple of years, who had a great deal, they've been saving thousands of dollars per year, but the reality is they may be hundreds of dollars under market right now.
Yeah.
And especially like a new owner coming in is going to see that as a big opportunity to move those rents to market over time.
There's your private equity opportunity.
Exactly. So Matt, let's talk on the apartment list and then go to this this piece from
I've been champing at the bit. Mention it, trying to shoehorn it into every article.
Yeah, so just what's going on with the apartment list? What do they have to say?
So super commuters. Now, this is data from 2021. I was a little bit disappointed, but it's still a valid point. They have a very convincing graph. But their point is that the number of super commuters has fallen to the lowest level in over a decade. I'm guessing supercomputers have risen, but that's just a misstatement by me.
One of the lines? Can we add that?
No, we could keep it, I think. I'd like to keep that one in there. Anyways, people aren't driving as far from work to and from. Driving even 40 minutes to work can really feel the life being sucked out of you. You can do anything during that commute time, whether it's sleeping in or spending time with your children, taking up a hobby. And I think people have clued into that idea. They don't like to drive so much. And it has gone from, now the numbers here. So they define super commuters as people that drive 90 minutes or more to and from work. So you've got 90 minutes to go from your home to your work. You got 90 minutes again. That is 3 hours of a day in your car. Now, let's see, 4.6 million people in America did that in 2019.
Wow.
And in 2021, 2 years later, it's only 3.1 million. So it went from basically
over 10 years with population growth, we went from 3.2 to 3.1.
Yeah, and on a percentage basis, it went from like 3.2% of the population were these super commuters now to 2%. We're dealing with small percentages, but the change in these percentages is significant. I think that it's got to be driven by more than housing costs, even though Apartment List does talk about housing affordability, how unaffordable housing encourages super commuters.
I was going to say, yeah, that makes sense. You have to live, far outside the city. You can afford to.
And I talked last week about the rings around San Francisco, where it's just ever cheaper in your Stockton, California, which is a San Francisco suburb, has the highest rate of super commuters, a full 7.4% compared to that national average of 2%. So in some cities, like in San Francisco and other really, really high cost of living cities, you have to have that job there. You've got to make it there. But I think, yes, that is one push. Having really costly housing is going to make people commute more. But hybrid work is going in the other direction.
Yeah, I think that's gotta be it, because especially if you have a commute, maybe you're not commuting in 5 days a week, and so does that disqualify them if they're like commuting, like if they're going to work 3 days a week, work from home too?
I don't know actually how that's added up, but I do know.
But a lot of those people are just like, hey, do I need to be in the office? Can I just commute? It's interesting.
And the rise of hybrid work also lines up with the idea that higher income, and this is what Apartment List has said, higher income workers are less and less likely to be these super commuters.
I believe that.
Yeah.
Yeah, there's like, no.
Well, and this is what I've been thinking of more and more. And I made this point, or I thought about this like a few years ago. It's like San Francisco's getting so expensive that how can a fast food worker live there? You got to be robots.
Well, I think my dad lives in Key West, and the people that the work in the service industries, hotels, restaurants, and in a place like on an island, and it's like that's it, and there's not like a bunch of suburbs outside.
Yeah,
where do you live? Like, and there are places that there's like Stock Island right outside, and like the other keys are cheaper than Key West, but it's all oceanfront property. So it's all expensive. How do you run? Yeah, the McDonald's and the Wendy's and all the the bars that aren't going to be paying $50 an hour for a cocktail waitress.
Yeah, and eventually you are going so far out of your way that it's like it's insane. Yeah. And I'm sure there are people that commute 2 hours to work every day.
Yeah.
I don't enjoy it. I don't enjoy that. At first, you run through all your podcasts.
I was going to say you have to embrace podcasts and books.
Yeah.
And the podcasts you'll go through, especially if it's like you're trying to stay up to date. You got to really lean into books. I mean, it's an opportunity to get yourself educated.
Yeah, that's a good point. But then you start a year and a half in, you start thinking about all the things we could be doing.
Oh, I know. You add up the time, but that's what I'm saying. You can make use of that time.
Yeah.
If you could get a whole degree. You get a whole degree.
People like it as like this is time for myself.
Yeah.
But
it's still a lot.
Yeah, it is.
And that's where you can say like a train's nice.
Oh yeah.
But no, it's not an option. All right, Matt. I want to jump into this because we're running low on time.
Yep.
But if you enjoyed the show so far, make sure that you're liking us, subscribing, and leaving a comment if you so choose. Let us know what you like, what you don't like. If you have an opinion or a question, something you'd like to see covered, we always read them and we really appreciate it. And if you want to get this type of information sent to your inbox 1 to 2 times a week, graycapitalllc.com/newsletter. Sign up for the Gray Report newsletter. It's the best multifamily intelligence newsletter in the country. For day-to-day updates, grayreport.com, #1 multifamily intelligence aggregator in the world. So there's that stuff to do. Homework. Okay, Matt, let's get into this. This is a very, I know it's your style,
Yeah.
More academic, from the University of Wisconsin, Da Lee and Timothy J. Ridio.
Yeah. Yeah.
The piece is persistently poor performance in private equity real estate. Boom, shot across the bow, Matt.
That's what we do.
That is what we do. Why is the performance so persistently poor?
That's what I said. This paper has a real throwing down the gauntlet thing going on.
Yeah.
I picked it because I'm drawn to things like this. This confrontational paper, it's an academic paper. It's incredibly relevant. Regardless of what they say, I'm going to dig into it. And I think that there's some valuable insights into this. And it doesn't necessarily say like, okay, get out of private real estate.
Yeah, it doesn't say real estate is bad. But it makes some really interesting observations about kind of the nature of the deals and the asset classes and the managers and the investors that invest in them that lead to this.
It's much more like a structural thing, I think, than it is saying like, okay, there are problems here. The market's going bad. It is examining the incentives and the kind of processes that are in place that are affecting what they think should be a survival of the fittest.
Yeah.
And
it's really not.
Yeah.
It's really not. So I just want to read the abstract, Matt, so that we compare buyout or BO, venture capital, and private equity real estate funds. RE funds underperform buyout and venture capital as well as a public market alternative. In real estate, worst performing fund managers survive at a high rate. They are also susceptible to diseconomies of fund scale with no skill-based persistence to offset the negative scale effects. Analysis of noisy fund manager selection indicates that RE or real estate investors are not disadvantaged relative to BO, buyout, and venture capital. LP investors in real estate funds seem to be optimizing something other than or in addition to investment return when selecting fund managers. So they're saying that it's not really just about the returns. They're looking, and it's just so true because investing is as quantitative as we want it to be. You can't ignore that it's an emotional exercise. People have emotional drives that are underlying the reasons why they're doing things relative to their fears, hopes, and desires. And certainly, I know many people are attracted to real estate from a standpoint of preservation, wealth preservation, taking a more conservative approach and a more steady, consistent approach rather than a typical investor in a venture capital fund that is looking to take max risk, looking for max returns.
Yep.
And so it's a little bit, and Matt, I haven't read the whole piece yet. It's 50 pages. I'm going to read the whole thing.
I suggest people skip to page 34.
Yeah. But I want to hear your analysis.
Yes.
And from our discussions, I want to talk about some of the structural underpinnings.
Yeah. And I really would like, so it does get very heady, and it only really started to make sense to me on page 34 where they set up why they think, things are, their metrics of how venture capital is performing, how buyouts are performing, and but they kind of justify why they think these things are happening. And their general thesis is that real estate funds do worse than venture capital or buyout funds because there's not a lot of whole performance gains from fund 1 to fund 7 or whatever. The VC unicorn can build knowledge and relationships and a network that could bring higher returns. So that's the venture capital advantage. The buyout specialist could master the financial engineering and organizational best practices that can transfer from one company to the other. But this paper's authors argue that this growing acumen is largely absent in the real estate world. Funds for real estate are as good in fund 1 as they are good in fund 12 or 7 or whatever.
Or even maybe not as good.
Maybe even not as good. And there is an idea with this diseconomy of scale that, you identify all your opportunities, all your real estate opportunities, and the well's dry. And they talk about how, you could do what they call, you could bring in a local sharpshooter, someone with local knowledge, but that guy's going to ask for a fee, so that's going to cut down on your returns anyways. You could do a value add or opportunity strategy, but they say that there are frictions that are substantial that are going to cut into your returns. They say these local sharpshooters could help you either get favorable political some favorable policy, or they could just know where everything is in the players.
And so is really what they're saying is there's an advantage to, I guess, smaller, maybe more nimble operators that are more niche focused that can go after, they say, sharpshooters after going after specific deals, rather than comparing to like the Blackstones or very large firms. And it makes sense. It makes sense in all asset classes. Not just real estate, that as your AUM, your assets under management grow, you have more money to allocate, and the pool of deals may or may not have grown. That's especially true. It's across the board, but with real estate, I mean, the deals, they don't scale like exponentially like, maybe like tech companies, maybe some VC firms. It's like, the deal sizes are like, you can go from doing 5 million to 10 million, and there's $100 million deals, but like, outside of that, like there's not very many $100 million deals, like of a particular asset.
One thing that I noticed, even just hopping on board Great Capital, was the deals that we're bidding on. These are not like a commodity where everyone needs them. There are maybe a small handful of bidders, of serious bidders for any opportunity.
That's 2023 versus 2020.
Yeah. Yeah. But again, like, it's not like there are people that are always, that there's not a huge number of players that are going to buy, and there is a very finite amount of opportunities, period.
Yeah, I think that the range is much more narrowly defined.
Yeah.
It's like the deal sizes are, if you're in a private equity space and you're at real, managing capital that's anywhere between, 10 and a couple $100 million, and you're looking at deals, call it 10 million to really maybe $75 million. But there's only so many of those.
Yeah.
And so that the deal size is kind of blocked off, but also, kind of that the returns are also in a more narrow box.
Yes.
Like there's not as much volatility. Like you can get, it's call it on a not great real estate deal, a high single digits IRR to a, call it 20-30% IRR, but it's within that range. Whereas like, but typically maybe even a smaller range. Maybe it's 12 to 18 is your typical median IRR range for real estate. 15 is kind of the target.
That's what they say in the paper.
Yeah, but for VC, I mean, you may be targeting, some may be at zero. You're going to take a loss.
Yeah.
Some are going to be, 1,000% IRR. And so that's scalability, the range and volatility of return outcomes.
Yeah.
And, you could be looking at buying a $5 million company that you're going to hope blows up in an early seed round that blows up to $1 billion company, or you can buy a $1 billion company that you hope to take it to, $10 billion. So there's such a wider range and opportunity to kind of scale that investment business. Yeah.
And that was their big thing, I think, was scalability, but also they were like, well, what are the pressures? The selection pressures. For VC and VO, it is largely survival of the fittest. We're going to pick the best. It quickly hones down on the major players that have these competitive advantages, and people invest money into the winners.
And it goes boom, boom. There's one winner, one leads to the next winner.
Yeah,
and it kind of leads off each other. Where real estate, it's not. There's not that inherent, I guess, momentum from one deal to the next.
Yeah.
Other than like, hey, we bought a deal, and maybe some people know us, we're buying the deal, but it's not like you're gonna. I mean, there are some advantages, but maybe not as pronounced as in the tech and VC space.
And then the argument here, and what really this almost boils down to, is risk, is consistency and risk. Now, when we're talking about demands, what are they demanding of these real estate investors? Consistency.
Yeah.
They said that they talked about an illiquidity premium, and they put premium in italics, not a liquidity premium, but an illiquidity premium. I forget which one was in italics, but they wanted to emphasize it.
Yeah.
And they're like, this is backwards. But these pension funds are the number one investor in real estate, or they are a big investor.
Yeah.
They're a big force that determines which of these are winners and losers. And the winners are the ones that can deliver a sense of consistency and a sense of that things are maybe less risky.
Well, if you think about it, and that's a great point. I'm really glad they had in the article, and you brought it up, Matt, is the big dollars in real estate are from institutions. It's pension funds, insurance companies, and the like. And if you think about the way they operate, they're very conservative. Once they kind of have their sponsors, like they've got their stable of operators, they kind of stick with them for a while. They maintain those relationships.
Yep.
Because it takes so long to kind of vet everyone and get comfortable. Because trust, and again, it's the other reasons besides returns. It's that sense of stability and safety, and a lot of that is through building the personal relationships and building up trust with these operators. And so you're like, I don't know if I want to go out and take a risk on another company that maybe they can squeeze out a little bit higher returns, but one, do I want to take the time to do it? And like two, like I know these guys, and that's why Blackstone's so popular.
Yeah.
There's a little bit of like, hey, well, this respectable firm's investing in this Blackstone fund. Why not us? It's we might not get the highest rate of return, but when our clients ask us what we're doing, and if they say we messed up, we'll be like, well, everyone is investing in the Blackstone fund or all these other large funds that have a great pedigree, because I think there's an assumption of, well, yeah, of course it's good. Some these guys, I'm sure, did the due diligence.
Yeah.
If these guys are investing with them, they're good.
Yeah.
So you leave a lot on the table, whereas I think maybe the profile of a VC investor is a little bit more opportunistic and really looking at maximizing their return. Rather than like, well, I want to, make sure I'm diversified and have a good. Real estate investors are much more conservative, I would think, on average than your
kind of like preservation and growth, but a little bit more towards preservation. Yeah.
So it's the, I guess my conclusion, or is it the investment managers, or it's really the investors, and the investors not keeping the investment managers accountable and not looking for new managers to maintain those level of returns.
And that's what I was
complacency.
And that's what I was thinking too. Is not just selection of real estate private equity over venture capital or buyout private equity firms. I'm thinking of, well, within the real estate space, what is valued, because their argument is kind of that the cream isn't rising to the top in the real estate space.
What they're saying is like, you all keep rewarding people who are doing an average job and they're not doing as good, and you just keep rewarding them for doing an average job.
And that's a structural thing. And it doesn't mean that any private equity, that means that there's a lot of variability when it comes to private equity real estate.
And then not all is the same.
Yeah.
And just looking at some of their their charts and their conclusions, Matt, I think Great Capital may be in the absolute sweet spot of like,
I know, that's right.
I mean, honestly, I was looking through, because it's, you obviously want someone experienced that's done enough deals, but they started to identify like after that, like kind of like fourth, fifth, sixth fund, like there's seems to be some tailoring off of returns, and it kind of flattens out, and it's because, again, like when I'm looking to buy 4 deals a year, I can make sure that they're the best 4 deals that's on the market. If I need to buy 40 deals to even accomplish that task, you're going to have to start making some compromises. And then you all of a sudden start making exceptions of like, well, this one's going to maybe return a little better, or this one's going to be under, but they're going to average.
Because you can't control what those 40 deals are.
No, how much detail can one person go in? So there's so many variables that kind of go into that process.
Yeah.
And you can see why versus a VC firm that's like, well, yeah, I'm still going to try to do 4 deals, but they're going to be 4 deals that are 10 times like the size.
Yeah. And I've been incubating these people for so long and building, and I know just the right people.
Yeah. I think that I don't think that's as much. I could see how that could play into it a little bit of like, okay, I'm in with one founder and he's just like a rock star and he's gonna go to the next. But like that also, I think, is a factor in real estate as well.
I was gonna say,
because we've experienced that, just anecdotally, of doing well on one deal or doing one deal leads to more relationships and building those relationships.
I was gonna say that too.
Brokers.
Even if just like property management, like it's almost discounting the idea. Well, like no, you can kind of master your craft on your first fund and do better in your second if you figure things out. If you figure out how better to operate. If you figure out you're painting your units too much, or you're charging too much at least, and there are some insights that are gained.
Yeah.
It may not be the crazy financial engineering that they're talking about with a buyout private equity, but it's still something.
I think fund 2, fund 3 seem to be the sweet spot of life. Those are the gangbusters. Yeah. So it's interesting, and I think it goes to show that you need to be specific on finding. There's a lot of average sponsors that are really good,
And-
but they may be at a scale where it's hard to deliver the same returns. So
Yeah.
one, past returns aren't necessarily an indication of the future.
Yeah.
And you need to bring that into your equation of, okay, yeah, we want you to be the right size, but we also want you to be too big of where, you're not going to be making
It's a bad
right deals.
it's a bad headline, but man, it does give you a really good roadmap to like, okay, this is how you pick a private equity real estate person. Pick someone that's maybe past their first one or two, but
Yeah,
but they're not sleepy.
I think the same paper could have been written with a different title of like not all real estate like the divergence of of like real estate sponsors.
Yeah.
I think if you broke down the different types of operators and their size, I think that would be a really interesting comparison also.
Yeah, that would be really interesting. So not all, you got to read the report. Maybe it's a little bit more than the headline.
No, just stick around for the Gray Report.
Because man, that is the cheat sheet. You look for a private equity real estate fund manager that has some experience, but not too much, and that's it. There's the sweet spot.
So Matt, when you're going through these equations, you got all this. You got all this.
No. I started at page 34 and I stopped at page well before these equations hit.
There's a lot.
That's
good. So math was done.
Yeah.
Or math was displayed.
I can get to the bottom of this. I tried to copy it into ChatGPT.
Oh yeah,
it didn't help me.
It didn't.
No.
Well,
I'll try.
No input, or what? It was,
well, no, I copied the whole thing. It was too long. But now
you gotta chunk it up. It'll take it if you chunk it, or we get the API all plugged in.
Yeah, fix it.
Well,
before we go, I do want to give an update about our coverage of Fannie Mae and their lack of coverage of suburban and urban real estate. I actually did reach out for them to comment, and they got back to me. And the economist from Fannie Mae called me in the middle of the day, out of the blue, and said, "Listen, you're important enough. We don't want to make you mad."
Yeah.
And he even said, like, "Listen, I'm talking to you. None of this, all these communications are cleared. And I just want to assure you."
So it was on the record.
It was roughly on the record, yeah. And he said that I want to assure you that the reason why Indianapolis urban market was selected and the suburban market was not in their list was because they picked the top 20 urban markets, the top 20 suburban markets, and the Indianapolis suburbs were just too much middle of the pack.
Yeah. That spin, Matt.
Yeah.
That spin. Because why did they have a suburban Minneapolis on there?
Maybe. Well, so it was top. It was like the top and the bottom that they picked. And so if you were fall too much in that middle range, then you didn't get in there. I want to have Fannie Mae, you're invited.
I'm not buying it.
All economists I'm gonna line up a
cover story.
We'll get an appearance.
Cover story.
He really sweet talked me, and I was on his side by the end of the 30-second conversation.
Okay. Yeah. You don't think that when you're going to cover something up that you're not going to.
That's true. Sweet talk.
That's the easiest. Just be nice and
that's a good point.
Friend.
Yeah.
And get suckered in.
I know. I was flattered, but they did get back, and that was nice of them that they responded.
That is good.
Yeah.
Well, we'll keep holding the powers to be accountable, Matt.
Yeah, that's right. No access journalism here. We are hard-hitting and objective.
Yeah, exactly. All right, everyone. Thank you for watching this week's episode of The Gray Report, available on YouTube and podcast, wherever your podcast. Make sure you check out graycapitalllc.com, especially if you are a accredited investor. Check out our latest deal one day when we have a deal. But get in touch with us. We'd love to have a meeting with you, figure out what you're trying to do in terms of your investment objectives, and if Gray Capital is a good fit. I think we're right in the sweet spot.
Oh, yeah.
I wouldn't work with anybody else, but that's just me, and I'm not giving any investment advice. All right, thank you for watching. Have a good day.